All right, welcome everybody. Anmol here again, and today I have a very special guest, Kirk Chisolm from the MoneyTree Investing Podcast, and also a wealth manager for Innovative Advisory Group. And today we're going to talk about, not only his investing experience and what he's learned in the markets, as well as having interviewed hundreds of traders on his MoneyTree Investing Podcast, what he's learned and what people should look out for going forward. So, great to chat with you, Kirk. Thanks for hopping on.
Yeah, thanks for having me on, Anmol. I really enjoyed the interview you had on my show. It was great. So
yeah, it was great. Thanks for having me there. It was definitely a great chat. Now, before we get started, just kind of give a little bit insight into people of, who is Kirk, what do you do, and, how you're helping other people in the investing markets as well.
Yeah. So, I started my career just out of college at Payne Weber in the wirehouse circuit, and that was kind of the borderline of a different era. The 90s was a completely different time. I legitimately started December of 99, which is probably the peak of the financial markets, a bubble. And then, the subsequent 3 years, basically markets went down. So I learned risk management very quickly. And I think it was really a good, at the time I hated it because you had to struggle through all that. But because of that struggle, I learned risk management, proper risk management. And, I carry that on me today, as opposed to people starting in the 90s who thought just the markets always go up. And so that's colored my experience and the way I look at things. And, so in 2008, I started my own company because we really wanted to think differently about investing, whereas the traditional channels, the broker dealers are really just focused on buying, never selling, not managing, but just purchasing stuff. So we really wanted to think about things differently and use risk management as a lever to help people run their portfolios. So that's a little bit about my background, and everything we do, we'll talk about it here, is about thinking differently about investing.
Yeah, I think that's great that you started in 1999, because if you're going to hire like a wealth manager, then you would want to see them go through all the tough times too. Because I saw the same thing. I knew so many people, back in the day that were really good traders, and because all this saw was markets going up, we could just keep buying and selling and keep repeating that process. And a lot of traders, got hurt from the trading standpoint when the market started to give it up. So, I think it's a good characteristic in any trader investor that they've gone through, they've seen the good and the ugly and the bad, and it helps people stay prepared for what might be still on the cards. So, looking at the market now, where do you see, are we closer to like a 2020 type of push up, or you think we're closer to, maybe something like a 2008?
Well, I want to first say that I can't predict the future, Anmol. So I think we all kind of learned that lesson early on, even though we all try. So, I think if we're looking at the markets right now, I have this thesis that we're in a different paradigm. And that started obviously 2022. It started before, but you can really argue that it started right around COVID. But we're in this new paradigm, which in my opinion reflects the 70s, which is we're going to be in this back and forth period where the market is going to go up and down. We're going to have periods like last year that freak everybody out, and periods like this year, everybody think it's over. And it's going to go back and forth for years. And I think that's inevitable. Do I think it's going to go up from here? I mean, if you look at the technicals, and we kind of broke out of a range, and we should keep going higher if we're, unless it's unless this is another fake out, which we see a lot. But I think realistically, you have to be focused on managing risk in times like this. We are no longer in the period where it's just buy and forget, buy and hope. And that was since 2009. Pretty much the markets went up. You had a speed bump. Oh, it'll come back. It'll be fine. They just keep printing money. We're in a different paradigm where they're no longer printing money, and they are having higher interest rates. Both of those factors lead to basically a market which should be compressing and not expanding. And it doesn't mean that because of it expanding that I'm wrong. It just means that the market right now is perceiving that, hey, things are going to be better in 6 months. Right, because the markets are a discounting mechanism like 6 months out, and they think, oh, in 6 months rates will be lower, the Fed will be printing money, and all that, which I would deduce is an accurate thinking about it, because the Fed has always done that, at least for the last 20 some odd years. And I don't think it's going to be the same this time, because inflation is a different animal that the Fed is afraid of, and they don't want to repeat the 70s. So in my opinion, we're going to have higher rates a lot longer than most people think. That's been my thesis for a while. In 2008, my thesis was we're going to have lower rates a lot longer than most people think, which was also true. So I think it's just going to be, we're in this new paradigm. It'll change when, inflation truly goes away, which I think we've got a few more years before that happens. And then maybe the Fed, boosts it down to zero again. They just say, hey, let's free money for everyone. So.
Right. Yeah, I totally agree. And there's a lot of talk also about like recession. Like, are we entering a recession? Are we in one? Like, what's your opinion? Are we in a recession, or are we entering one, or we're nowhere close to that? Where do you stand on that?
I honestly, Anmol, I'm not smart enough to be able to predict that. The even the people who are predicting recessions don't know. I think the reality is it when we start having word conversations of what words actually mean, it's a problem. Like, what does a recession actually mean? Because ultimately, you say, well, technically we're in a recession like 6 months ago, but the Biden administration came out and said, well, actually, we're not in a recession. Here's why. And they came out with their thesis. And, you look at that and say that's political buffoonery, but in a way they weren't wrong. It's not like we had a bunch of jobless claims, unemployment's going up. There were a bunch of factors that really, they may not technically mean recession, non-recession, but they are heavy influences on it. If you have a very low unemployment rate, are we in a recession? I don't know. I mean, you get into this this soup of like, what's going where, everything's just thrown together, and you just like take a guess. You're like, I guess we're in a recession, or I guess we're not. Like, that's how it feels. And I think the challenge that most people have, and this is actually one of the reasons why I think we're repeating the 70s, is the 70s was almost a mirror image of this one point, which was if you had to peg the sentiment of the 70s, it was mass confusion. People didn't know what was going on. Stagflation was a thing. It had never happened before. At least people hadn't coined a term called stagflation before. And people didn't know. They didn't understand. What, we have high inflation and low productivity, and the markets aren't going anywhere. I don't understand what's going on. People didn't get it. And now we're in a very similar period with this new paradigm where people are going to be confused about the direction, because they're wondering, well, basically the Fed has directed markets for the last, since 2009, and now they're doing something different. So, but people are still, they're ignoring that, right? So this is my favorite thing. Don't fight the Fed. That term. Don't fight the Fed. It's, the Fed's printing money, it's going up. They were right. But now that rates are up and the Fed's not printing money, I don't hear anybody saying don't fight the Fed on the other way, right? That's somehow just missing from the conversation. So I think people see what they want to see and believe what they want to believe. I think the recession is not going to really matter until it matters. And then people start talking about it. So that's kind of my thinking around it, is I'm just kind of ignoring it. Housing, I think, should be a lot lower, but it's not. How do you have high interest rates? People can't afford houses. I can afford a house that is 40% less than I could 2 years ago. And yet somehow people are still buying houses. How? I don't know. So, the numbers don't make sense. I feel like I'm living in Alice in Wonderland, but if you look at the end of the day, what I think doesn't really matter.
Yeah, totally agree. I was actually talking to our traders about this. It's like, we're just in a twilight zone. Just trade what you see. Don't try to have any opinion or bias, because none of it matters anymore. Like, 10 years ago, if you were telling me about there's a potential war going on, we're sending cluster ammunitions, and then all sorts of stuff is going on. And then now today, the news came out that former president is going to get indicted in jail. Typically, if these things happened like 10 years ago, you would have seen the markets, react to that. And today is just like, nope, let's go back up again. So I think that's one of the things we're seeing is like a just twilight zone, and nothing matters anymore. Just, trade what you see. Now, shifting gears a little bit, like a lot of people are saying that AI is going to cause deflationary environment, right? Because as AI comes in, companies are going to be more efficient. Where do you stand on that? Is AI going to bring deflation? Is it going to bring prices down? Or do you think people are going to lose maybe more jobs as a result of that? So it's kind of balance each other out.
Yes. So, no, seriously though. So the answer to your question is this. Technology is naturally deflationary. Okay. If you look at computers and what they've done to our economy in the last 20 years, it's deflationary. I can still buy a top end computer for $2,000. When I went to college in the late 90s, I bought a top-end computer for $2,000. The computers have got drastically better. It's still $2,000. I'm not talking about like the ultra high-end gaming, which is like 20,000. I'm talking about like a bump down from the high end, like just one bump down, $2,000, $2,200. It's been that way for 25 years. So naturally, there's a deflationary aspect of technology. And as technology progresses, that is still going to be deflationary. If you think about the economy as a whole, there are big factors that impact this. And this is one of the things I look at and why I kind of have a certain thesis. And most people look at money printing. That's one, right? And here's another: globalization. We've had globalization for the last 25 years up until recently, where where US is outsourcing its labor to different parts of Asia that have cheaper labor sources. And it's so cheap that you can build stuff there and send it back, and it's still cheaper than if you manufactured it here. So the globalization aspect has been hugely deflationary. And now that engine is reversing and is actually causing inflation, which people are not, I'm not hearing a lot about this. But if you think about technology itself, right? The advent of computers, of AI, of blockchain, of all these, of the internet, all these things are deflationary. AI, I think at some level, I'm not sure it's going to be deflationary in the sense that you're talking. I think it is definitely going to take jobs. But I think in the short term, it's going to be another tool that people use to become more efficient. But we're still going to be working the same number of hours, if not harder. And there will be jobs that will kind of go, not necessarily go away, but they'll definitely get rid of certain jobs like video editing, audio editing, writing, content for SEO or whatever. There's going to be a ton of content of jobs that are going to just kind of disappear. People will still use people. So there needs to be a people wrapper on it, because not everybody knows how to prompt AI. And we don't have applications yet that have built-in prompts that are really good. But what it really brings up is this, is what we're effectively doing is we're centralizing intelligence. So all of the internet centralized, it basically allowed us to communicate with everybody across the world, which normally you couldn't. You could get access to information everywhere from anybody. Right. And obviously it's not entirely filtered or true, but you have the data. Before, you never had the data. So now with AI, it's centralizing the data. So what it's centralizing is the collective intelligence, and it's picking what is true and what isn't true. Now, I don't know if that's a good idea or not. I would say maybe not in some levels, but somebody brought this example up, and I thought it was really interesting. So let's say you're on Facebook, right? You're doing Facebook ads, you're advertising your company, you're doing Facebook ads. And Facebook says, hey, you can do your own ad, or we'll do the ad for you. We'll do everything. We're going to collectively use everybody's best practices, and we're going to do that. And that's better, right, than what everybody else does. So everyone starts using it. So is it effective? Because everyone's the same, right? There's no competitive edge because everyone's the same. So is it working? Well, it's not going to work very well, which means you have to go do it yourself, right? You have to go out and you have to be better than AI. Well, what happens if you're better? AI takes it and then they implement it and they start using it. And now you're the same as everybody else. So what it's going to do is it's going to flatten the field, and it's going to minimize the edge that people have, because it's going to learn from it, take it and apply it to everybody using it. And now you don't have an edge anymore. So
that's a really good point.
So the interesting thing is, where is the future edge going to be in these activities? And trading is definitely going to be one of them. What if, if everyone uses the same algorithm? You're going to say, well, I'll use a different algorithm. So trading is interesting in that, if somebody finds the perfect solution, other people will copy it. It's no longer the perfect solution. And they'll do this, and people copy it. It's no longer the good solution. So the good thing about trading is you're always kind of finding little areas that have alpha. But I think what's going to happen with AI is going to flatten the field a lot more than people think. And I think it's going to destroy a lot of livelihoods as they exist today and cause people to do other things. So I think that's what the implementation of AI is going to do over the next few years. It's not going to be right away, but over a few years, that's what's going to happen.
Yeah, that's definitely a very interesting time in the world that we're in, because it feels like when internet came out, right? It's kind of like the early stages of that, where how is AI going to use crypto, and what might come out of it. There's like a whole debate around that. As a funny story, I had one of my employees. He's a copywriter, so he writes all the emails and stuff. And we had a conversation when the whole Chat GPT came out. I'm like, so what do you think of that? He's like, oh, I'm actually no longer a copywriter. I'm like, wait, what? You're working for us? He's like, yeah, I'm now an AI expert. So like he pivoted according to that, and now he's showing other people how to use the right prompts. And he pivoted. I'm like, that's very smart. But a lot of people are going to get caught off guard, and they're not going to be able to pivot in time. And by the time they do pivot, everybody's doing the same thing. So yeah, totally agree with that. It's a great point. Um, and changing gears a little bit, just tell people a little bit about what's your philosophy when it comes to investing in the markets. Like, what's your style? What's the overall investment philosophy? How do you think about the markets?
Yeah, I think, you and I talked on on my show a lot about this. I think you and I think alike. The way I look at investing and trading is, risk management is an important part of that. And I think any trader will agree that if you can't survive today, you can't trade tomorrow. So I take a look at the same thing. I mean, I remember 2000 to 2003. I remember 2008. I remember COVID. I've been through this multiple times. If you don't have dry powder at the bottom of the market, you can't invest. So you always have to have an eye out for risk management. So whatever we do has to have a defined risk associated with. And so I've got I look at investing like a set of overlays, like a bunch of overlays on top of each other. A mental model is the way we think about it, right? If you just invest in this S&P 500 index, that is an overlay. You're indexing, right? Okay, if that's all you're doing, okay, that's one overlay. Well, let's say you add options to that. Okay, you add options. That's a second overlay. It's a second level on the model. So, for instance, we use options as a way to manage risk, whether it's selling covered calls or whether it's buying puts to define the risk on the downside. All of that is highly dependent upon our thesis on the market. So we don't have a single strategy. I've come to the conclusion over the years of investing and trading is that you cannot have a single strategy. I know that goes against the line of thinking what a lot of people say, but if you really think about it, if you look at the top traders, right, the legendary traders that everybody knows, you'll notice that they have multiple different models that they use. They use one model, and when that stops working, they switch to a different model. They've already got these pre-populated, right? They already know they've got 5 or 6 models. They use one or two, they stop working. All right, we're going to switch to these two, and then they're going to start working. They're going to stop working. We go to these two. So we just keep flipping in terms of what's working and what isn't. And I think the way I look at it is in different paradigms, different things will work. So prior to 2022, pretty much putting all your money in the fantastic the fantastic 7 or whatever you want to call it stocks, that was a winner. You're making 100% returns a year just by doing that. Stupid, but you can't argue with stupid. Like it happened, right? And I don't like that from a risk management standpoint, but that worked for a lot of people. But now that's not necessarily the case, right? It wasn't last year anyway. So you have to look at these different overlays and say, what is the most important overlay today? So the way I look at it is I use a combination of technical and fundamental, right? I want to buy companies that I never have to sell. And I look at some of these companies, and if they're cheap enough, I'll buy them. So I'll give you an example, like Meta, for example, not a company I want to buy. It's still one of the FANG stocks. It's not a company I want to own. I think that their model is a little broken. I don't like their model at the moment. So I think, there's some suspect there about the continuation of their profitability in the same degree. However, when I look at the fundamentals, when they bottomed out, I don't know, a few months ago, it was really attractive. It actually, it hit my fundamental metrics that said, hey, this is actually a buying time for it, because it made sense. And actually would have been a good time to buy, but I don't agree with their model. I think it's flawed at the moment. So I didn't buy it. But had I agreed with it, I would have just bought it, right? And just held on, and it would have been fine. So I use both. I think the technicals are extremely valuable, because if you don't, as you mentioned, if you don't follow the price, then whatever's going on in the economy it's not connected. It hasn't been connected for decades, by the way. The economy and the data has not been connected to the stock market for quite some time. At least not the way it was decades ago. You could argue whether it is or not, but decades ago was much cleaner. Now it's not. So look, we should be in a recession. We're not. The stock market's going up. It should be going down. Whatever. I don't know, but I have to follow the price, right? The price is the ultimate truth arbiter. And so I have to use technical judgment as to whether this makes sense. So we were in a trading range most of this year and last year, at a certain part last year, we were in a trading range. There was high and lows, it was bouncing around. It broke out a month ago. So, all right, it broke out. So we're going in. We're assuming it's long, right? I don't like it. It doesn't feel good. It feels weird because it feels like this is a fake out. But what do I know? The wisdom of crowds. I'm not, I'm not the truth arbiter. So price says what it is. We're going long, and as it goes long, we'll keep going long, and that's it. And when it starts to turn, we'll change our mind. But that's kind of how I look at it. Is you have to have different overlays for different market conditions. And I'll give you another example. I might be buying call options now because my thesis is it's going long. A few years, like 5 or 6 years ago, options premiums were so cheap that it didn't make sense to sell premiums anymore because we were doing covered calls, cash covered puts, and it got so cheap. I was like, we can't earn any premium on this. Why don't we just buy options? Which was crazy because we were selling options for like a decade. And now it made sense to buy. So, hey, let's start buying options again. And that's what we did. And, we made some good money. And then, of course, hiccups start to happen and then things change. But ultimately, you have to look at the conditions you're provided. You can't fight the conditions. If it costs me 10% to buy a call option when it used to cost me 4%, maybe that doesn't make sense. Maybe I should be selling it instead of buying it. So that's how I'm looking at it.
That makes sense. So you start with the fundamental approach. First, you try to pick the company that you like the business model for, and then you look at technicals to try time the way in. What about on the way out? Do you ever sell these investments? And if so, like, what's your criteria for saying, okay, we need to exit this position? How do you decide that?
Exiting is so much harder than entering. So I think the way I look at it is I've got legacy stocks that I like. And these are stocks that we buy them when they're right price and we hold on forever, right? They're legacy stocks. Now, that being said, forever is a long time and forever does change. So if a business model changes, like I said with Meta, the business model changed. Apple changed it for them with their, lack of data and other things. And I think they've failed on the metaverse and all that. So I think they're stumbling a little bit, which makes a good buying opportunity. So it's a question of whether it's a sustainable model. And I don't know that it is. But if I looked at a company like Microsoft, for example, Microsoft's not going anywhere. No one's coming out with new operating systems. Apple's not going to take over much more market share. It's going to be a pretty consistent utility, if you will. Now, they could do smarter, stupid things. I'm not going to argue that. But if they were selling for fundamentals that hit my markers, that's a company I would buy, right? Or Johnson & Johnson, right? They come out with a bad court ruling and it dings the stock price. Okay, that's a one-time event. It's still a strong company. McDonald's, Coca-Cola, all these companies. If you can get them cheap enough, get them cheap enough, right? And hold on to them. And as long as they fit the metrics, you can, and they get the same kind of return that you expect, hold on until things change. If Coca-Cola started selling baby diapers, I'd say, all right, maybe I should get rid of Coca-Cola, right? Because it's not sticking with what I bought for. So I think if you're buying individual stocks and you're buying for a long time, that's how I'd look at it. But we do a lot of options with indexes because, frankly, unless you're buying the FANG stocks, you're not getting paid for the alpha of picking individual stocks anymore. If you're trading, that's different. I'm not talking about trading. I'm talking about investing. Trading is whatever's moving, right? But when you're investing and you're holding for long periods of time, whether it's swing trading, whether it's investing, something you're going to hold on for as long as it rides, you want to be able to understand the model and have backing of it. You're not just riding it because it's moving. That's different. Like, that's trading. But I use indexes a lot because, frankly, that's the direction of the market. And the options tend to be much cheaper if you're buying them on indexes. They tend to be more liquid. There's so many advantages to using indexes over individual stocks. Everyone's got their preference. My preference is if I'm doing option strategies, I use indexes. Because I also don't have a single stock risk, which I do with single stocks. So that's why I said I have to really own the individual stock. I have to really want to own the upside, the downside, the fundamentals. I have to be bought in all the way. So even a hiccup will be fine. And it's hard to do in this environment. So indexes are easier, which I know everyone else is doing too.
Yeah. So one of the things you said is like when there's a change in business model, you might consider or take a reevaluate the position again. And so when it gets cheap enough to hit your metrics, you buy it. Is there such a thing where it gets expensive enough that you might consider taking profits or partial profits? Example would be, let's say, you probably wouldn't own Zoom, but let's say if you did own Zoom or Roku and you were holding it till 2020 when they all went up insanely in terms of percentages. So is there such a thing in your model where it gets expensive enough that you might consider taking profits?
Yeah, it's a hard decision to make. I think we would all agree. It's just as hard as, it's probably harder than buying, because where do you get out? And I guess the way I look at it is you have to have if you have a forever time frame, then I just leave it as long as the business model is working. I think that's the way I look at it. However, if I'm buying like a company that is not a forever stock, you have to have some sort of plan in place to get out when you get in, before you get in. I'm going to sell if it drops this price. What I typically try to do is I try to have either trailing stops, or what I do is a trailing stop that's tied to the technicals, right? So if I'm doing a 10% trailing stop and we like I said, like I'm looking at the S&P and it's bumping above a trading range that I perceive as the trading range, then I'm going to put a stop loss a little bit below that support system. So if it breaks below support, then I'm out, right? Because I'm not day trading, so I do it more on a macro scale. So I'm just watching the market, and if it goes below there, I'm out. And that's the way I'd look at it, is just you have to have a trailing stop. You have to have some rule in place that doesn't allow you to make emotional decisions. Because in my experience, like it's like, oh, it just went a little below the technicals, and then it's a little bit more, and then you've had a big loss. I look at it and say, if it hits this price, I'm out. If I'm wrong and it goes back up, I can always get back in. But I think for me, it's more about making sure that I've defined the risk and I put together a strategy for getting out before I get in.
All right, that makes sense. And yeah, I think selling is definitely the hard part, especially on the winning positions, because you always end up selling too soon. And then like Nvidia, that's one of my bad exits of just a few months ago. Sold it right before it started the gap up. And I thought, hey, I'm getting 150% whatever return it was from the lows, but then I missed out on the big move that it recently had and continues to have. Switching gears a little bit. So I know you interviewed a lot of people and traders, investors on your MoneyTree podcast. What's one of the things that you might have picked up, like insights from interviewing other traders and investors, looking at different styles of trading and investing? What's maybe one insight you picked up and one common theme you noticed that all good traders and investors talk about?
Yeah, so I think the one lesson that I picked up that is really important that nobody talks about is that everyone's got a style. Oh, day trading is the best. Arbitrage, swing trading, this, that, the other thing. Everyone's got a style that they're pitching as the best style because it works for them. And what I've learned is this is not just for trading. This is all walks of life in anything. Like people tend to love what they're doing because they're good at it and they think everyone else can do it and should do it. What I've learned from talking to investors that are successful in different walks of life is obviously there is no single approach. There are successful people who do Warren Buffett's approach. There are successful people who follow Carl Icahn or David Einhorn or the countless other people who are really good at what they do. There are plenty of people. I mean, Vic Spariendo, who I interviewed on the show, was an options trader from the 70s and just made, I think his lowest annual return was 70% in a year. Like he was making ridiculous returns. This is back when options were like, just starting out. So you could do other things you can't do now. But regardless, like he was making ridiculous returns, never had a down year, just absurd performance. And I look at that and say, well, that works for him. It may not work for me. It may not work for you. right? What he was doing worked with him. So the lesson that I pulled from all this is you have to align your trading style with your investor psychology. So the way I describe it is this: some people need action. They need to go to the casino. They need to trade 5 times a day, 10 times a day. They need action, because if there's no action, they can't sit in their hands. So if I said Warren Buffett has by far the best return than anybody anywhere, and you could look at it and say, yep, I agree, and I plug a day trader into that model, they're going to blow up. Because the reason Warren's successful is because he's not trading. So if you got a day trader in there, he's going to trade way more than he should, and it's not going to work. Just like if you took Warren Buffett and said, you're going to be a day trader, he'd fail miserably. Terrible day trader, right? It's not his style. He knows that. And he knows his alpha comes from sitting and reading and waiting for obvious opportunities. And that's what he comes up with. Now, he has made mistakes over the years, for sure. Made some big ones in oil and gas, and now he's back in it. But he is a very successful man who's understood his own investor psychology and went with it. And I think if you look at the most successful investors and traders ever, they've all found a way to align their investor psychology with their style. So I think the first lesson I would tell everybody is understand yourself. You got to have a little bit of mindfulness about yourself, what you're actually like. If you're thinking like, oh, somebody did day trading, I really want to do that. Do you really want to do that every single day, all day? Like, is that really going to work for you? And sometimes you need to make mistakes, but ultimately, if you don't align your psychology for what actually works for you, for what you can fulfill. If I give everybody a set of rules for 10 different styles, if you can't fulfill those rules ongoing every day, all day, don't do it, right? So you need to understand yourself and then align with the right style. And you're going to have a lot more success if you do that than anything else. Because there's a lot of successful ways to invest. Like I know, Anmol, you have some successful ways. I have some successful ways. They may be different. Your way may not work for me and vice versa. I don't know. But I know that there are a lot of people who do things right and there are a lot of people who do things wrong. And the ones who do it wrong are typically people who have a misaligned style and psychology.
I think that's the best point. And everybody should take note of that because it's 100% true. Like your style might not be right for somebody else. And I've seen that by coaching other traders and investors. Like you're trying to coach them into a scalping style and they just can't do it because it's too fast. But then they thought, okay, maybe it's not for me. I'm going to quit. But instead of quitting, if they just looked at a different time frame, they made for good swing traders. They made for horrible day traders, but they end up becoming good swing traders and vice versa, where person came and he just wasn't patient enough to hold on to these positions. So he made for a better scalper. So I think it's finding your right style is kind of one of the best things ever. And also adjusting to the markets. Like, for last few years, I was doing the holding style, holding on to those stocks. This year, I'm like, I want to do in and out. I don't know where things are headed. I'm just going to trade the ranges and make money that way. So absolutely, I think everybody should be finding the right style for them and not getting swayed by, I guess, what the next hot style or next, like Kathy Wood, right? Like she was doing extremely well. And I remember this infamous tweet when she tagged Berkshire's return and her returns and showed how she was crushing it. But now look at it. If you look at it now, Berkshire's still going straight up and she's all the way back down. So I think that's one of the most important things to consider. Now, tell us, like, where can people, learn more about your podcast, or if they want to work with you, with your advisory group, where can they learn more and how can they work with you and get in touch with you?
Yeah, if people want to find me, you can go to MoneyTreePodcast.com and you'll find the show there. We're on all of the major podcast networks. We're easy to find. Just MoneyTree Investing Podcast or MoneyTree Podcast. You'll find us. And that's the best way to get to know me about, the show and all that. If people want to work with me, you can find me at innovativewealth.com. That's the company that I do wealth management through. And, we're not really doing day trading for people. So it may not be a good fit if that's your style. But if you're looking for somebody to manage your money or to manage the core of it, like maybe you're trading part of it and you're learning and you want the core to be managed by somebody who, you respect and who you understand how they think, we might be a good fit for that. So innovativewealth.com is where you can find me. I'm easy to find them everywhere. So, but thanks for having me on, Anmol.
No, definitely. Any last words of wisdom for people listening, like what they should look out for going ahead?
As we say on our show for our tagline, invest in your life. Your your best investment comes from the investment in yourself. And that comes from personal growth, professional growth, learning, constantly learning about trading, learning from other people, getting coaching, getting help. I do this all the time. I'd say the best significant advances in my life have come from pushing myself, learning, learning from other people, getting coaching. All of that is really important. I know people don't want to invest in themselves, but honestly, it is the one thing that moves the needle more than anything else. If you're in a business, you're looking at, all right, where am I investing my money? Am I investing in real estate? Am I investing in, more product or whatever? But if you invest in yourself, that is an asset that you could bankrupt your company. You still have that asset. You could go through bankruptcy court. They can't take your knowledge away from you. You will always have that. I interviewed a guy, Doug Casey, who's a crazy guy that I love. I think his ideas are just really interesting. He's a little older now, so he's harder to find, but he's just a fascinating individual that rubs people the wrong way, but he's learned a lot. And I look at people like that and say, all right, if he's doing things different every day, like what can I do differently? Like what can I learn from a guy like that I can apply to my own life? But he's got this model that he says, this is what he's saying. He's like, hey, you can drop me in a jungle in Bolivia and I'll come out smoking cigars, being best friends with the president within like a month. Like that's the kind of guy he is. Like he's not from the military. He's just like the kind of guy you could he'll just make it happen because he's got so much growth that he's put in his whole life that he can just do anything anywhere that he wants. And that to me is, I think, the ultimate currency, that you're wise enough, you've grown enough, you've learned enough that you could apply that skill everywhere and you'll be successful. So that would be my one takeaway, that people invest in themselves.
Well said. Amen. I really enjoyed the conversation. Thanks for coming on. Appreciate it.
Yeah, happy to come on, Anmol. Really had a good fun time today, and hope the listeners enjoyed the show.
Thank you.